Somewhere in the last 6 months, without a single press conference, a group of the richest and most powerful people in the world all made the same quiet decision. They started selling. Not small amounts, billions of dollars in stock, moving out of their own hands in some of the very companies they built. And here's the part that should catch your attention. This is happening at the exact same time regular investors are being told this is the greatest moment in stock market history to buy in. So somebody is wrong. Either the people selling know something the buyers don't, or the people buying know something the sellers don't. By the end of this video, you'll be able to answer that question yourself. Let's start with the numbers, because they are bigger than most people realize. In the first half of 2026 alone, corporate insiders in the United States sold about $77.6 billion of their own company stock. That is the second fastest selling pace in more than 20 years. The only time it was worse was in 2021, right before markets took a hard turn. Now here's the twist that makes this even stranger. During that same period, insiders only bought about $6.9 billion of stock. That's barely above the lowest buying level seen in 7 years. Read that again slowly. Executives sold 11 times more stock than they bought. If you owned a business and truly believed its best days were still ahead, would you be racing to sell your own shares in it? To understand why this matters, we need one simple idea from finance. Every single trade needs two sides, a buyer and a seller. Nobody can buy a share unless somebody else is willing to let it go. That means before you ever buy a stock, there is one question worth asking first. Why is the other person selling? When it comes to company insiders, this question hits differently. These are not strangers guessing about a business from the outside. These are founders, executives, and early employees who see the internal numbers months before the public ever does. They read the real growth reports. They sit in the rooms where hard decisions get made. So when the people with the most information decide to cash out, it's worth paying attention. This isn't a new pattern. It has shown up before, right before some of the biggest financial crashes in history. Rewind to 1999, the peak of the dot-com boom. Companies with barely any revenue were rushing onto the stock market, and investors were throwing money at anything with .com in the name. That single year, tech companies made up more than half of every business that went public in America. Then 2000 arrived, and the story flipped. Over the next 2.5 years, the Nasdaq lost more than 75% of its value. Trillions of dollars vanished. It took 15 years for the index to fully recover. Fast forward to 2021. A different vehicle, same pattern. Hundreds of blank check companies rushed onto the stock market that year, raising well over $100 billion combined, promising to merge with the next big thing. One of the most talked about listings of that era, a major direct-to-market crypto exchange, went public near the very top of the boom. Within about a year, its stock had fallen more than 80% from its opening day high. In both cases, the pattern was identical. Excitement peaked, insiders sold, then the ground gave way. There's a third example worth mentioning, because it shows this same pattern outside of tech entirely. In the years leading up to 2008, banks kept expanding their lending and packaging riskier loans into products they sold to everyday investors. Right up until the moment everything collapsed, the public messaging stayed confident. But behind the scenes, some of the very institutions selling those products were quietly reducing their own exposure to them. The public got the optimism, the insiders got the exit. 3 very
different decades, 3 very different products. The same warning sign every time. So the real question becomes, is 2026 following that same script? Let's look at what's actually happening right now, with real names and real numbers. This year, the 4 biggest technology companies in America are on track to spend around $725 billion building artificial intelligence infrastructure. That's a 77% jump from the year before. To put that size in perspective, it's more money than the entire yearly economic output of many mid-sized countries, spent almost entirely on computer chips and data centers in a single year. Meanwhile, one of the most talked about AI companies in the world just filed paperwork to go public, aiming for a valuation as high as $1 trillion. Its yearly revenue is real and growing fast, crossing roughly $25 billion. But here's the number buried underneath the headline. For every single dollar of revenue that company brings in, it currently loses about $1.22. Read that twice. A company can be valued at $1 trillion and still be losing more money than it earns every single day. And this is exactly the environment where earlier this year, some of the most recognizable names in technology sold enormous blocks of their own stock. This happened at the same moment that global institutions like the IMF and the Federal Reserve were publicly using the word overvalued to describe parts of the market. Here's what makes this even more interesting. All of that spending, hundreds of billions of dollars, is flowing towards a small handful of chip makers and data center builders. It's created a strange loop where the same handful of giant companies are essentially paying each other with money that ultimately has to come from somewhere. If the revenue on the other end doesn't show up fast enough to justify the spending, that loop gets a lot less comfortable for everyone
standing inside it. And it isn't only unprofitable companies drawing attention. Even among the most successful AI businesses, some competitors are only just now reaching their first profitable quarter, years into the boom, while others are still burning billions to keep pace. That gap between the companies that are quietly becoming profitable and the ones still racing to spend is exactly the kind of gap that shows up right before markets start sorting winners from losers. None of these individuals are dumb. They didn't build some of the most valuable companies on earth by accident. So why would people that sharp choose to sell now, in the middle of what's being called the biggest technology boom of our lifetime? This is where the psychology becomes just as important as the math. Imagine you're at a party that everyone agrees is amazing. The music is loud, the energy is high, and nobody wants to be the first one to leave, because leaving early feels like admitting the party might end. But everyone quietly knows parties do end. The smart move isn't to never go to the party. It's to know that the moment it starts feeling like it can't possibly stop is often exactly when it's closest to stopping. This is why insiders keep participating in booms even when they privately doubt they'll last forever. Staying in feels safer than looking foolish for leaving too soon. But quietly moving your own personal wealth toward the exit while publicly staying enthusiastic, that's not contradiction. That's just what experienced players do. There's also a simple herd instinct at work, and it doesn't disappear just because someone has a lot of money. Watching everyone else stay in a rising market creates enormous social pressure to stay in too, even for people with access to better information. Nobody wants to be the executive who sold too early and missed the biggest gains of their career. So the selling tends to happen quietly in the background through pre-scheduled trading
plans rather than dramatic announcements. It looks unremarkable, one transaction at a time. It only becomes obvious when you zoom out and add it all up. There's a phrase from a famous investing teacher that captures this perfectly. In simpler words, the wise investor tends to sell to the optimists and buy from the pessimists. In other words, the best time to sell something is when everyone else is desperate to buy it, and the best time to buy is when everyone else is scared to touch it. That single idea explains almost everything happening in today's market. So what does this actually teach a regular person, someone without insider access or a finance degree? First, price and value are two completely different things. A stock price tells you what people are currently willing to pay. It does not tell you what a business is actually worth. Those two numbers can drift very far apart, especially during periods of intense excitement. Second, watch what insiders do, not what headlines say. Anyone can go on television and sound confident. Actual buying and selling activity is much harder to fake because it involves real money leaving real pockets. Third, excitement itself is not information. The loudest, most exciting story in the market is often the most expensive one to buy into, precisely because everyone already knows about it. None of this means you should panic or avoid investing altogether. It means the opposite. It means understanding what you're buying, why the price is what it is, and who is on the other side of that trade. So here's what you can actually do with this starting today. Before buying any hyped-up stock, spend 10 minutes checking whether company insiders have been buying or selling recently. This information is public and free to look up. Build a habit of asking one question before every investment. If this business is truly this good, why is the price this cheap? Or why is someone else this eager to sell it to me? And finally, protect
yourself with the boring basics that always work in every market cycle. Diversified index funds, patience, and time in the market beat trying to guess the exact top or bottom. Let's go back to where we started. A group of the world's smartest, richest people quietly sold billions of dollars of their own stock at the exact moment the public was told to buy in with excitement. Maybe they're wrong. Maybe this time really is different. But history has a habit of rhyming, and the people closest to the numbers rarely sell out of boredom. You don't need to predict exactly when the music stops. You just need to make sure that when it does, you're not the last one still dancing. If this kind of clear, no-hype breakdown is useful to you, subscribe to Money Cabinet, because we're going to keep reading the room